Whether you are new to stock investing or if you've been around for a while, you will have heard the term fundamental analysis that gets thrown around all the time. What is it and how important is it for you as an investor? The first thing to understand is that fundamental analysis is crucial only if you are a stock investor. In other words, if you're buying individual stocks. If you invest in mutual funds or index funds, then fundamental analysis is of not much value to you. So then what is fundamental analysis? Well, with over 17 years in this industry, coupled with a few degrees, these finance jargon still overwhelm me as they did when I first heard them. So don't worry if you feel the same. I'm going to keep things simple. In absolute simple terms, fundamental analysis is a health assessment process of any business. I like to call it the BMI of the stock market. Like how BMI is used as a screening tool to understand the overall health of an individual, fundamental analysis provides critical insights into distinguishing between a good stock and a not so good stock. The ultimate goal of fundamental analysis is to determine the intrinsic value of a stock. I know that's another jargon, but don't be put off by the name. An intrinsic value is nothing but the fair value or the true value of a stock. It's just determining if the stock is undervalued or overvalued. It's not as terrifying as it sounds. Something most of us do on a day-to-day basis if you think about it. When we shop around for things, don't we all check the price and question the value proposition in our heads? Like, is this thing worth it? So in a nutshell, fundamental analysis of a stock is just that, determining if a stock is worth its market price. Fundamental analysis has two main aspects: qualitative analysis and quantitative analysis. Qualitative analysis involves assessing the quality of a company, such as understanding the business model, brand value, competitive strategies, management credibility and competency, integrity, customer satisfaction. How is the company different from its peers, just to name a few. These are non-quantifiable aspects with a certain degree of subjectiveness that cannot be defined in absolute numbers. But they are vital insights while choosing strong companies to invest in. Again, this is not as complicated as it may sound. We all subconsciously do this analysis on a regular basis. If we were to buy a car, for instance, wouldn't we all conduct our own research on the brand, their credibility, the competitors, any potential red flags to whittle down a few options? It's the same process with stock. Just studying the company's socio-economic position in the market before buying a stock. Quantitative analysis, on the other hand, involves assessing the value of a company based on true statistical data. Unlike qualitative factors, these are measurable elements. The biggest source of quantitative analysis is a company's financial statements. Continuing with our previous example of car shopping, analyzing financial statements is like going through a series of checklists when buying a car, such as fuel efficiency, safety, price, quality, driving comfort, design, etc. To simplify further, we could also say financial statements are like the food labels. Just like food labels, examining the financial facts when shopping for stocks can help you make better choices. There are three main financial statements used in stock analysis. These include balance sheet, income statement, and cash flow statement. Balance sheet is a snapshot of a company's financial position at any given time. It shows if a company is healthy or not. Income statement shows a company's revenue and expenses. And cash flow details company's cash inflows and cash outflows. A simple analogy to explain these three statements would be, balance sheet is like a fitness report showing someone's current fitness level, includes things like how much they currently weigh, their body measurements, etc. While income statement and cash flow statement are like the diet and exercise regime that led to the current fitness level. They are directly linked to the fitness report. All publicly traded companies are required to produce these three financial statements each quarter, and these are publicly available on the internet for free. Let's look at each in a little more detail. Starting with balance sheet. There are three components to a balance sheet. First, we have assets. This is what the company owns. These can be tangible items like building, equipment, inventory, real estate, or intangible assets like patents. It also includes cash and investments. Next, we have liabilities. This is what the company owes, such as debt and accounts payable. Most liabilities will have an offsetting asset, so the liabilities incurred to acquire an asset. And the last item is equity. This is the amount that would be left to shareholders should the company cease to trade and sell all its assets and pay all liabilities. Balance sheets are arranged according to this equation. Assets is equal to liabilities plus shareholders' equity. Ultimately, all three items of a balance sheet must balance to provide an accurate picture of a company's financial state to know if it's overstretched or not. Next is the income statement, consisting of revenue and expenses. The top line of an income statement shows a company's revenue, that is, money from doing business, whether it's selling goods or services, and any other income such as dividend income or interest income. Then we have expenses associated with running the business. These are operating expenses which include cost of raw materials, wages, and other overhead costs including interest on loans, asset depreciation, and income tax expense. The bottom line is earnings. This is derived by subtracting all expenses from total revenue. This is essentially your net income or net loss, showing how much the company has either gained or lost for a set period. Finally, the cash flow statement. This shows money flowing in and out of the business. It consists of three items. Operating activities. This includes cash generated from the company's main business and cash spent on the company's main business. This gives an estimate of company's profitability. Then we have investment activities. This is cash generated from and cash spent on company's investments like property, equipments, and other businesses. And finally, we have financing activities. This includes cash flow associated with company's financing activities. This could be dividend paid to shareholders, repayment of debt, which accounts for cash outflow, or issuing bonds or stocks or borrowing debt from a bank, which accounts for cash inflow. So simply put, a cash flow statement tells you if a company has enough money in its pockets available to pay future expenses, reinvest in business, provide good returns to shareholders, etc. Essentially, it shows where money is coming from and how it's spent. It's important to note that all three statements are intricately linked. Net income from income statement is linked to equity in a balance sheet and cash flows from operations in a cash flow statement, and the net cash flow in a cash flow statement is linked to cash balance on a balance sheet. Now that we have briefly seen what financial statements are made of, the question is, how does one translate all the complicated numbers into meaningful conclusions? These facts and figures are of little value for you as an investor if you don't transform them into meaningful interpretations. Remember, the final goal is to determine the intrinsic value or the true value of a stock. And that's where the financial ratios and indicators come into play. The information in financial statements is used to deduce several ratios that help investors in their stock picking process. Some of the key ratios derived from financial statements that can then be used to analyze a stock are EPS, PE ratio, PEG ratio, dividend yield, price to sales ratio, return on equity, etc. Thankfully, we live in an era where these are readily available on the internet for free. Different investors use different methods to predict the future of a stock. I will cover some of the standard ways of analyzing a stock using these financial ratios in my next video. So to conclude, fundamental analysis, whether qualitative or quantitative, is far from foolproof. It's merely an assumption or an educated guess about the performance of a stock based on the relevant fundamental factors. It depends on how each investor or analyst translates the available information and thinks the stock is worth, similar to us buying any day-to-day goods, for example. Ultimately, it's what we make of the available facts. Hopefully, when we go through the financial ratios in the next video, you should get a fair idea on how fundamental analysis can add value in stock picking and help determine the intrinsic value. That's all for today. See you in the next one.